Hi, Bruce here from Voodoo Trading. Welcome to our YouTube series where we walk you through how we execute our systematic, rules-based trading strategy. Once again, we're not suggesting that you should purchase the securities that we highlight here, but rather see the steps and the thought process that we go through to remove emotions from the trading process and systematically implement our trading rules. It is our belief that each trader should develop their own trading strategy that fits their personality and with rules they understand and can systematically execute. You can get more info on our trading strategy and info on how you can start building your own trading strategy in the description section of this video. Okay, let's get started and review the markets that are on our watch list. Take a look at a new entry signal our trading strategy generated last week, and at the end of the video we'll review the performance of our active trades. Okay, let's look at the markets that are currently on our watch list. The first trading rule of our trading strategy defines the 50 or so diversified portfolio of markets that we follow. Each day we scan our market portfolio to identify markets that are approaching our buy criteria and add them to our watch list. As a trend-following trader, your buy criteria is usually a breakout above a moving average, a breakout above a previous higher resistance level, or a moving average crossover. You can see from the table here that we currently on our watch list we have sugar, gold, silver, the biotech sector, soybean, base metals, healthcare, and the emerging market equity index. All are broken out above the 200-day moving average and also above a previous high. Gold and emerging markets have not yet had a golden cross where the 50-day moving average crosses above the 200-day moving average. Every day after the market closes, we review our watch list to see if our entry trigger is met for any of the markets on our list. Gold was on our watch list and was identified as a potential trade setup because it was approaching a 4-month previous high of $14.72 that is shown by the green dashed line on the chart. You can also see that gold is trading above the 200-day moving average, but the 50-day moving average crossover the 200-day moving average has not yet occurred. Gold is an interesting market as it usually does well in an inflationary environment such as what we have seen in 2022. But as you can see by the chart, it's been in a downward trend for much of the year and appears to have completed a bottoming process in October of 2022. Hopefully this is the start of a new uptrend, but only time will tell. As a systematic rules-based trader, we don't try and predict what markets are going to do. We simply act on the signals that are generated. We're trading the CGL ETF in Canada, but a similar trade setup exists on the IAU Gold Trust in the US. Our trading rule number 3 states that we will enter the trade if there is a follow-through on the breakout. We placed a buy on stop order above the breakout close of $14.81, and our order was filled, getting us into the trade. Our trading rule number 4 states that we must know where we will get out of the trade if we are wrong and the upward trend does not continue. As with most successful traders, we are wrong more than we are right. We placed our stop loss at $14.30, which is shown by the pink line on the chart. We calculate our stop loss using an average true range, or ATR, which measures the average volatility of the ETF over the past 20 days. You can see from the red dashed line on the chart that the ATR was 17 cents when we initiate the trade. In order to give the trade some breathing room, we use a 3 times ATR, which in this case is 51 cents. We calculate our $14.30 stop loss price by subtracting the 3 times ATR from our purchase price. As soon as our entry order is filled, we place our stop loss order with our broker so that the trade will automatically be closed if the stop loss price is hit. Once we know our entry price and stop loss price, we can calculate how many shares of the ETF we should purchase. In this case, we were willing to risk 0.5% or $500 of our theoretical $100,000 portfolio if we are wrong. By dividing our bet amount of $500 by the difference between the purchase price and the stop loss price, we determine that we can buy approximately 980 shares of the security. Defining the bet size of every trade is the key to long-term trading success. If you would like to see how this trade turns out, please subscribe to our channel below and click the bell and you will be notified when the next video is released. If you think the info that we have discussed so far in the video is useful, please hit the thumbs up button below and share the video with your friends. Okay, let's take a look at our active trades. As you can see in this table, we currently have 6 active trades. We currently have open positions in the emerging markets ETF, sugar, gold, materials sector represented by tech resources, base metals, and healthcare sector. The majority of these trades have been initiated over the past month. Prior to these trades, we were completely out of the market since the summer, when we were stopped out of our winning commodity trades. It appears that being out of the market for the past 6 months was a good thing, as we avoided a sell-off in nearly all the market sectors. Over that time, our trading strategy did not generate any new buy signals. We are currently about 50% invested. When we're out of the market, we park our money in a money market ETF or mutual fund. With the rise in interest rates over the past year, some of these funds are now returning over 4 or 5%. We haven't seen those type of interest rates for risk-free investing in quite a while. We have no way of telling if these new buy signals generated over the past month will result in winning trades, but as a systematic rules-based trader, we must take all the signals our trading strategy generates. If we are stopped out, we have only risked about 0.5% of our portfolio on each trade, so it won't ruin us, and we will simply take the new signals when they are generated until the trades become profitable. Our trading strategy currently has a 35% success rate, so we can expect to be stopped out on at least half of these trades, and that's okay. It's part of the process. Please let us know if you have any questions or comments on today's video. Thanks for watching, and we'll talk soon. Good luck and good trading.